This conference will now be recorded.
All right, welcome, everybody. So tonight's training is going to be on insurance basics and terminology, and this includes all licenses, whether it's the life only, the accident and health only, life accident and health, the property and casualty broker agent, the personal lines agent. Even adjusters need to get the basic terminology down on their exams. So that's kind of what we're going to be covering tonight. And again, you guys are all self-muted. If you do have any questions, just hop on in. It's a small group. I like being, informal and, I like the interaction. So don't hesitate if you have a question, or some of you may have taken the test and like, I saw this, but it was worded like this. Give me some insight because it'll help the other people also. All right. Let's go ahead and begin. So there's the exam, and then there's the real world. A lot of this stuff that you're learning is to help you pass the exam. So you're learning some definitions and terminology for terms that you're not going to use, but you got to know it to get through this exam. The first one is insurance. So insurance is defined as a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. I mean, that's the technical definition that you may get on your exam. Or you just might say insurance is a contract, or insurance is a contract of indemnity, or insurance is designed to renew to what you had before loss, per contractual relationship with an insurance company. I mean, there's different ways of saying it. You will get a question on this, but I don't know how they're going to define it. That's the thing. But I definitely want to emphasize, you got to know the difference between the definition of insurance, where it's a contract of it to indemnify you because you suffered a loss from an unknown or uncertain event. And then the definition is different from the concept of insurance. Now, the concept of insurance is transferring risk, right, from a large group, those people who pay for insurance, to the small group, those that suffer losses, right? So the concept of insurance, think of risk transference, not the definition. So keep them separate. And this is where people do trip up. A lot of people, when they send me their exam results, I mean, maybe they have a tough time with commercial or the personal line side, but a lot of them is this general information, the general insurance section, which is the definitions and terminology. Right? So I definitely want to expand on that. So insurance is a contract of indemnity. Okay, well then great. Now we got to know what indemnity means. And indemnity means to restore you to the condition that you had prior to a loss. So if it's a 3-bedroom, 2-bath house before the fire, if your house burns down with proper coverage, we're going to rebuild the exact same layout of the 3-bedroom, 2-bath house. We're not going to give you a 5-bedroom, 3.5-bath house with a sun deck, a pool, and some skylights that you did not have before the fire, because that was a gain that improved your condition, and that's not what insurance is about. So indemnity means restore you to what you had prior to a loss, and that's it. Now, in order to buy insurance on something or somebody, you have to have what's called insurable interest. Insurable interest is defined as having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. Okay? Okay, thank you. All right. So what that means is, in order to insure something or somebody, you have to have insurable interest. Or a lot of times the test will say economic interest. That means whatever you're insuring, if a loss occurs, there has to be a financial effect for you. If you're not affected financially, why are you even spending money buying a policy? And the insurance will catch that, and they'll deny the coverage. And so in the life and health insurance world, you only have to prove insurable interest one time. That's the date of application. Afterwards, it doesn't matter. But you do have to prove insurable interest at the date of application or at the time the insurance goes into effect. I mean, they may say it one of those two ways, but not afterwards. And the beneficiaries of a life insurance policy don't need to know that they're a beneficiary, and they don't need to have insurable interest. So let's say you want to buy a policy on your spouse. So you get married, you want to buy a policy on them. Well, that's great. You need their permission. You're the owner of the contract. They're the insured. right? And if something happens to them, you're probably going to name yourself as beneficiary. So you're the owner, they're the insured, you name yourself as beneficiary. Okay. You only have to prove that insurable interest in life insurance at that time when that policy goes into effect, not afterwards, right? So you prove insurable interest, you buy the policy on your significant other, your spouse, the policy's issued, right? 5 years later, unfortunately, there's irreconcilable differences, you divorce, go your separate ways. After the divorce, you're still paying premiums on the policy. 5 years after the divorce, right, they pass away. You can actually still collect even though there's no insurable interest, all right, as long as the policy is enforced. So in life and health, like I said, you only have to prove insurable interest one time only, date of application. In the property and casualty world, you have to prove insurable interest twice. Number one, when you purchase the insurance, just like in life and health, but number two, when the loss occurs. Now, all of your property and casualty contracts are short-term contracts. And you might get that on the test, right? A short-term contract means it's good for up to 1 year, right? So you bought a house today, you buy a homeowner's policy on the house. In order to buy the homeowner's policy, you have to prove you're going to own this house. And that's fine, but you have ownership, right? Going through escrow, they make sure the insurance is in place to protect both parties, and so you can buy the policy. So now, you bought the insurance, you paid annual premium. 6 months later, the real estate market goes through the roof, higher than it is now, and your house is appraised at double the purchase price, so you sell the house. 2 months after you sell the house burns down. Now, you still have a policy in force if you haven't canceled the policy when you sold it, because let's say you paid for the whole year, you bought the house, you have insurable interest, 6 months later you sell it, 2 months after that the house doubles, your policy is still in force because you haven't canceled it, but you cannot collect from that loss because it's not your house, because you don't have ownership or insurable interest at the time of the loss to collect. The insurance company will refund the 6 months premium that you didn't own the house, but you couldn't collect for the loss. Right? And so remember that in the property casualty world, you have to prove insurable interest twice. When the insurance goes into effect and when the loss occurs in order to collect. Now, there's one more caveat associated with that. So let's say you have a grandfather, they own a house, and in the will, they decide to leave the house to you, which is awesome. You run out and buy a homeowner's policy on this house. The house burns down. Can you collect on that policy you purchased? And the answer is no. Okay, so I said grandfather owns a house. In his will, he's leaving it to you. Right? So you buy a policy on it. Well, you shouldn't have been able to buy the policy on the house because it's not your house. Okay, so, but if the house burns down, grandfather's still alive, they have the insurable interest, you don't. Okay, that's why you cannot collect. So even though you're expecting to have insurable interest, you got to have insurable interest at the date of application in order for that contract to be valid. All right, so be wary of that question. The definition of the word person. Person under the exam is any legal entity. That's person, association, organization, partnership, business, trust, corporation, or limited liability company. Any one of those is a person. And the test does throw that around. An insurance agent is a person. An insurance broker is a person, okay? Or a life agent is a person. That means an insurance agent could be a corporation because that's what a person could be. Right? A life agent could be a business trust, okay? So be wary of that. A person is any legal entity. A natural person is an individual human being, just like you or I. So whereas an agent is a person, an insurance solicitor, who typically works under a broker agent, right, must be a natural person. A natural person is an individual human being, right? So as an insurance agent or a life agent, you can actually incorporate, but if you hire an insurance solicitor on the property and casualty side, they have to be an individual human being. You cannot hire a corporation, or I should say a corporation couldn't get a license as a solicitor, right? So be aware of that. And it's kind of tricky. You know, a natural person is a person, but a person is not necessarily a natural person. They're basically saying poodles are dogs, but not all dogs are poodles, because we have labradoodles and other stuff. So beware of that. Person is the larger category. Natural person is a subcategory of that definition. So make sure you understand the difference. Law of large numbers. You're going to get this quite a bit. The larger the number of similar risks that are combined into a group, the more predictable will be an insurance company's future expected losses. Okay, more predictable will be the future expected losses, not actual losses. So the law of large numbers basically says we measure the past to give us some predictability as far as the future. Now, when we measure the past, we have to measure large units. A lot of times your test will say large homogeneous exposure units. Okay, I know it sounds like milk. So large homogeneous exposure units. So you measure the past to predict the future. So in life insurance, we have mortality tables. Mortality tables predict what's the likelihood of you dying based on your age and sex and a couple other factors, right? So the insurance companies have tracked millions of people's lives over a long period of time to get some predictability as far as what's the likelihood of people dying in the future. So using a 2001 Commissioner Standard Ordinary Mortality Table for life insurance, right? Out of 1,000 male babies that are born right now, one is expected to die. Okay, we expect one. One may not die, and we definitely don't know which one. So with the law of large numbers, you cannot predict individual loss. You can only predict expected losses in a group based on measuring the past. Right? And so that's mortality. What's the likelihood of you dying? Morbidity is for health insurance. What's the likelihood of you becoming disabled, right, through sickness or disease? Okay, so it's a little different table. In the property casualty world, we use that also, right, to come up with the pure rate. I'm going to use San Francisco County. In San Francisco County, on average, there's 2 small fires every day. That's on average. That doesn't mean every day we have 2 small fires in that area, right? It just means historically, if you average it out, it ends up being 2 small fires every day. But in reality, we could have a couple weeks go by where nothing happens, and then one day, 20 homes burn to the ground. Okay, it's a tragic day, but over the long run, it still spreads out. Okay, so the reason we have this is so insurance companies know how much premium to charge in this area to have the reserves to cover those losses that are expected in that area. Remember, they're not actual losses, they're expected losses. That's how you need to understand that. Right? So keep in mind, with the law of large numbers, you cannot predict individual loss, right? And you cannot measure the future. It's to predict expected losses in the future, not to measure losses in the future. Right? They're not actual. Risk. Risk is defined as the uncertainty of a loss. Right? Your house may burn down, it may not. You may get into an auto accident, you may not. You may suffer disability, you may not. Okay, so, it's uncertain. And that's how you want to understand risk. It's uncertainty of a loss. We do have 2 specific types of risk that you do need to be aware of, for speculative risk and pure risk. Let's start with speculative risk. Well, speculative means like gambling. In gambling, you could win money, you could lose money. You could even break even. And so if there's a possibility of loss or gain, which gambling is basically a good example, the insurance companies will not issue a policy. Since insurance contracts are contracts of indemnity, it's only there to cover the loss. So if you can get a gain, that kind of contradicts what the rule of insurance is all about. And so we do not insure speculative risk. Pure risk is the risk that we can insure. And pure risk is the possibility of loss only. No gain. Okay, and so you do need to know the difference between the two, because I'll give you a scenario. Which of the following may be insurable? Right? Can you insure the outcome of a sporting event? No, because you could get a gain from that scenario. Can you insure the outcome of the lottery? No, because you could actually win money. Can you insure the liability at a sporting event? Yes, because someone could suffer a loss. All right, so that's how you kind of want to understand that part, okay? All right. So once we know that there is a risk situation, the next question is, how would you like to manage it? All right. And there's 5 methods of risk management. I use use the first letters, STARR, star. Okay, that's an easy way to remember it. Sharing to me is just a spin off of transferring. I'll get to that in a minute. But let's say you do have a loss exposure, right? I'm in California. Earthquake is a hot topic. Okay, and so let's say you own a home in California, and should you get earthquake coverage? Well, before you choose to buy it, well, you got to know your options. Number one, if you don't buy the earthquake coverage, then you're going to do what's called retention or retaining the risk. Retaining the risk means you don't buy insurance. So if a loss occurs, you pay for it. That's flat out what it is. That's retention. I'm not going to buy insurance. I will cover it out of my pocket. The only time that you would truly retain risk is two things. Number one, the worst case scenario is known. That means if a loss occurs, you know the maximum amount it would cost you. Okay? That's number one. Number two, you could afford it. Okay? If you could do both of those, or answer yes to those, do you know the maximum amount that it would cost you for this situation or this loss, and can you afford it? If you say yes, great, you can go ahead and self-insure. That's retention risk. But most people can't. Okay? Another subtle way of retention risk, by the way, is increasing your deductible. Your policies, your property policies have a $250 deductible. Well, you want to cut your costs? Raise your deductible to $1,000. Okay? By raising your deductible to a higher amount, that means the insurance company doesn't have to deal with small claims, the frivolous ones, with all the admin costs and everything associated with it. And so they save money and they pass that premium savings over to you. Higher deductible means lower premium. Lower deductible means higher premium. So by raising your deductible, you are retaining more of the initial cost of a claim, right? But the caveat is you get lower premium, right? So, and that's how you want to understand that. So going back to earthquake, let's say we didn't want to retain it, not too happy with that, we can reduce the risk. Now, how we reduce the risk or reduce the loss is let's retrofit the house. So pay additional money to have them retrofit the house so that the house stands up in a pretty good shape, okay? That's reducing the risk, reducing the possibility of a loss, okay? If you don't like that, you can go to avoidance of risk. Avoid risk is just sell the house, move to some area where there are no earthquakes, no fault lines, all right? Then you'll never have an earthquake loss because there's no fault lines in your area where an earthquake could occur and do damage. Or the fourth way is to transfer the risk to the insurance company by paying the premium. And if a loss occurs, right, pay your deductible and the insurance company covers the cost to rebuild your house. Okay. So those are your methods of risk management. And you can choose to apply that to most situations in insurance. All right. So let's say you have some high theft items like jewelry. Okay. Well, number one, you could retain it by self-insuring, right? Don't buy the increased coverage for the jewelry. Just, go ahead and replace it out of pocket. Number two, reduction risk is don't keep it in a jewelry box on the dresser in the master bedroom, which, burglars would target if they broke into your house. Keep it in a safe deposit box or maybe in the butt of a turkey in your freezer where a burglar typically wouldn't look. And that would reduce the likelihood. It can still get stolen, but it's less likely because it's in either a more secure location like a safe deposit box or someplace where a burglar typically wouldn't look. You can avoid risk, just sell all the jewelry so there's nothing to steal, right? Or you can transfer the risk by buying the jewelry coverage. So in the event your jewelry is stolen, it gets replaced, right? So those are your options. Now, when we go to transferring, buying the insurance, there's two ways that we can transfer, right? And that rolls over to sharing the risk. So sharing the risk, number one, reinsurance when you first buy the policy, right? Or if you kind of went low on the insurance, then you can do the co-insurance where you're sharing in the claim with the insurance company. So reinsurance is sharing the risk with other insurance companies. This happens in all lines of insurance where you're going for high coverage amounts. So you meet up with an insurance company because you want to buy some liability coverage for a certain event. Okay, you're renting a hotel ballroom to have a party. They want you to have $5 million worth of coverage for liability, and you go to a company and you want to buy the $5 million, and they say, great, but we can only handle 1 million. Okay, I mean, that's their limit according to Department of Insurance, and that's what we call a retention limit. Retention limit is the maximum amount of risk that a company may assume on any one policy. And so we'll say this company's retention limit is 1 million. Now you need 5 million. So this company could actually sell you 5 policies, right? 5 policies, $1 million each. That equals the 5 million which you need. But the problem is you're buying 5 policies. That's 5 admin charges, 5 expenses that maybe you don't want to pay. And so what that first insurance company could do is they could go ahead and write the 5 million face amount. They take on the first million, and then they share the remaining 4 million with 4 other companies, $1 million each. So let's just keep it simple. And so your contract, your $5 million contract, is backed by 5 companies. Now this is called reinsurance, where they're taking the risk and they're sharing with other companies behind the scenes. Most people don't even know that their policy may have been reinsured. Okay, it's kind of an insurance company function. All you know is you bought a $5 million policy with this first company, and then behind the scenes, they're sharing with other companies. That's all that is, okay? And it's kind of cool. It's kind of neat that companies can do that where they share the risk. And so this small, brand new company can actually write larger face amount policies because they're sharing the risk behind the scenes, which reduces their exposure initially, right? And reinsurance, that's kind of what that's about. Co-insurance is sharing in the cost of a claim. In the health insurance world, after you pay your deductible with a major medical program, you pay a deductible, and then you're going to share in the cost of a claim, usually 80-20. So you pay your deductible, then you pay 20% of your medical bills, the insurance company picks up 80% of your medical expenses. And so you're sharing in the cost of a claim. Well, in the property and casualty field, we also have co-insurance. And some insurance companies impose it in their contract. They make it a requirement that you actually have at least 80% of coverage to the value of the building. See, a lot of people, they want to go cheap. They don't want to insure the building for 100% because they're probably thinking, I probably will not suffer a total loss. So why would I insure the full amount? And so I'll just insure 50% because the fire station's just around the block, and if there's a fire, they'll be here to save most of my property anyway. And so insurance companies require them to carry 80%, and if they insure for less than that 80%, they actually have to pay more of a claim. Right? And that's co-insurance. That's kind of a penalty for underinsuring. All right? So when you're on my website, for those of you that have registered, at the bottom, there's links to additional webinars, and I do have one about co-insurance, and I give you a couple sample questions that you might see on the test, okay? And how to calculate that math question. For those of you in the health insurance world, if you're going to my website when you're logging in, doing the accident and health portion, I do have the major medical expense plans or medical expense plans webinar, and I do discuss and show you how co-insurance is calculated on that, okay? Peril. On the life and health exam, you may get one question on peril. What is a peril? A peril is defined as a cause of a loss. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause losses. Right? Now, they might flip it, by the way. A cause of a loss would be known as which of the following? Peril. Okay, so sometimes the question's the answer. This is a question that's the answer, but when you take the test, they might flip it where the answer is the question and the question is now the answer. And so I always say, don't memorize my questions, understand the concepts. When you see peril, look for cause of a loss, or vice versa. Okay, and so in the property and casualty world, you do have additional questions, and we have what's called cause of loss forms. And cause of loss forms are forms or policy forms that list perils. So if peril is a cause of loss form is a form that lists perils. Now, if it's a named peril form, it's going to list the perils we cover. Like a standard fire policy covers fire, lightning, removal. A dwelling policy basic form covers fire, lightning, and internal explosion. Okay, so those are named perils. If it's on the list, it's covered. If it's not on the list, it's not covered. Now, the opposite of that is an all risk or open peril form. And all risk or open perils, it does list perils, but it lists exclusions, perils that are excluded from coverage. And think of catastrophic losses, nuclear risk, war or active war, flood, earthquake, intentional acts, and wear and tear are common exclusions. All right? And so named peril forms list perils that are covered. All risk forms list perils that are not covered or excluded from the contract, I should say. Okay? So they're opposites. Okay? So if you have, let's say you have a named peril form and you want to know is, collapse covered? Well, we have to look at the list, and if collapse is not on the list, then it's not covered. But on the all risk form, I look at this list of exclusions, and if I don't see collapse as an exclusion, it's covered because it's not on the list. The all risk coverage is more general, more broad, because you can only list so many exclusions. And if a loss occurs that's not on the exclusion list, it's covered. All right. And so you give the different cause of loss forms. These are the general categories, but you've seen basic, broad, special. Basic and broad are named peril forms, right? And special form is an all risk form, so it lists exclusions. You also need to understand the relationship between hazards and a peril. So a peril is a cause of a loss. A hazard is a condition that would increase the likelihood of a peril or a loss occurring. So an example of a hazard would be you have badly worn tires on your car. Right? That means with badly worn tires on your car, you're more likely to experience an accident. Okay? And so the hazard is like a catalyst to a peril. Right? In the life and health world, I would say smoking is a hazard. It even says it on the side of the box, right, for your cigarettes. Okay? Warning, the Surgeon General has declared that smoking may be hazardous to your health. Okay, blah, 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 blah. Okay, and so the peril would be cancer. So the hazard is smoking would increase the likelihood of you getting cancer, which increases the likelihood of a loss or a peril occurring. Okay, and that's how you want to understand that relationship. Now, there's different types of hazards. We have a physical hazard, which is something structural and tangible. The badly worn tires is a good example, right? Another example would be living next to an explosives factory. It's physical. You can reach out and touch it, okay? Moral hazard is where people have a tendency to lie, cheat, be dishonest, right? The easiest way for you to understand this one, moral, when you see an L at the end, L is for lie, okay? People will lie to your face, especially in the auto insurance world. You even tell them, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? And they say no, and then we look them up, and there's a bunch of items there. Okay, they lied, right? We still will insure them. We just charge them more, depending on how serious it is, right? Morale hazard arises out of carelessness. On the test, a lot of times you'll see having an indifferent attitude. Okay. Now, when I say indifferent attitude, that means careless, reckless. Someone who's a risk taker. They drive fast. They go, skydiving, scuba diving. They're a risk taker. Okay. Which means they're more likely to suffer losses. And so make sure you know the difference. Moral ends in an L for lie. Morale ends in more, or you can break it down to more ale. Okay. When you drink more beer, you get careless and clumsy. Right, so that's an indifferent attitude. You got that liquid confidence, you take more risk, and that's how you want to understand morale. Okay, but you got to keep these two separate because they will ask you a question on one, then give you answers on the other one. So make sure you know the difference. Legal hazards are those people that are going for more money than they're legally entitled to. Someone who suffers a disability or maybe a workers' comp injury in their home, and they're collecting income, and they drag the claim out. Sometimes on the test, you'll see they malinger after a claim. That means they drag their feet and getting healthy and going back to work, right? Because they make the same amount of money sitting home playing PS4 as they would earn while working. Where's the incentive to get back to work, okay? And so that's a legal hazard where, the insurance company is continuously paying these people, right, which is exceeding what they should be receiving. That's how you want to kind of understand legal hazard. People that are going for more money than they're legally entitled to. Okay. Some other definitions, you got to know what a loss is. And again, the technical definition is a reduction in the quantity, quality, or value of an asset. The loss doesn't have to be great. I mean, a dent on your fender doesn't really or shouldn't bankrupt you, but it will cost you money to fix the dent. Or if you didn't fix the dent and you sold the car, you'll get less than what you thought you would get because they're going to point out, hey, there's a dent. Okay, so that's kind of how you want to understand that. And the example I use is dent in the fender. That's a direct loss. A direct loss is direct physical loss, damage, or destruction of property. Okay, that would be like a fire, destroying your house. Okay, the indirect or consequential loss is because of this fire, now we have this other loss. So because your house burned down due to the fire, now the insurance company has to cover the cost to put you up in a hotel until we rebuild your house so you can move back in. So the direct loss is your house burned down. The indirect loss is covering the cost to put you up at a hotel, called additional living expenses, which is part of the loss of use section of your policy. Okay. The direct loss would be a restaurant burns down. The indirect loss is because they're closed, the owner is not getting the normal revenues that they would normally earn while being open for business. And so the insurance company can pay business income, right? Lost revenues. Okay, that's the indirect or consequential. Very few times you might see it as residual loss. Okay, but it's like after the fact, there's this other loss. Okay. Aggregate limit. When you see this on the property casualty test, make sure you get this one down. You'll get this question. Aggregate limit is the maximum your policy will pay for all claims during a policy period. So if you have a homeowner's policy with $1 million, which is a per occurrence limit, a lot of times your aggregate limit will be $2 million. So you're allowed 2 basically full-size claims with that particular program. Once you exhaust that $2 million aggregate limit, if you had a third claim within that policy period that exceeded that $2 million, you're going to have to pay for it yourself because you exhausted the policy limits. So be wary. There's an occurrence limit, which is the maximum we'll pay for this one situation, but the aggregate limit is the maximum we pay for all of these situations during this policy period. So it's all of the little claims added up. If it exceeds that aggregate limit, then the insurance stops, and you're going to self-insure the rest from then on. All right. Sublimit versus inside limit. In the property and casualty world, it's called a sublimit. In the health insurance world, it's called an inside limit. And what that is, it is a limit on a certain type of loss within the overall policy maximum. So if you had $300,000 of personal property coverage on your homeowner's policy and someone broke in and stole your jewelry, the sublimit on jewelry, theft of jewelry, is $1,500. So even though you have $300,000 of personal property coverage, the insurance company is only going to pay $1,500 for theft of your jewelry. So it's a limit on a certain type of loss within the overall policy maximum. Well, for health insurance, that's like an inside limit. So let's say you bought a major medical policy with a $6 million lifetime maximum benefit amount, and you go to a chiropractor. Well, even though you have a $6 million checking account for your medical care, you can only use, let's say, $10,000 towards chiropractic care. So that's a limit on a certain type of loss within the overall policy maximum. The same concept, just different coverages. Sublimits for property and casualty, inside limit is for the health insurance world. Liberalization. You typically don't get this in the life and health world. I just want to differentiate. Liberalization is in the property and casualty world. What's going to happen here is the insurance company will send you an advance notice that we're going to expand the benefits of your policy for no additional charge. So liberalization or liberalize, expand your coverage for no additional charge. They just have to give you an advance notice. Okay, typically 60 days advance notice for homeowners policies and 45-day advance notice for commercial coverages. Right? This happens more often than you think, It's just that anytime you get a letter from your insurance company that says this is not a bill, you probably don't pay too much attention to it. But it could be one of these letters saying we're increasing the coverage on your homeowner's policy in this area, and there's absolutely no additional charge to you. How's that? Okay. Subrogation. This is, again, these next three items are in the property and casualty world. Subrogation. Someone without insurance loses control and drives through your living room. And now you can sue them, and you're going to win because their car's parked in your living room. Okay. But I just said they don't have insurance. In fact, they don't have a whole lot of anything. You know, they got a part-time job at a fast food chain, and that's the reason they didn't keep the insurance, because they couldn't afford it. Okay. But then they drove through your living room. So rather than you sue this person and get like $25 a month in good faith payments, because that's all they can afford with their part-time job, that will take forever for you to collect enough money from this person that damaged your house to put a deposit on the contractor to rebuild your living room. But you have an insurance policy, and one of the perils that's listed in your policy is damage due to vehicles. And so you pay your deductible. The insurance company covers the cost to rebuild your house, pay you what you're legally entitled to, so you can go on with your life. And then the insurance company takes over the claim and goes after this responsible uninsured motorist. All right? That's subrogation. We pay you what you're legally entitled to, and then we, the insurance company, deal with the claim from here on out. Okay, that way you don't miss a beat. You go on living your life. All right, let the insurance company deal with it. Appraisal versus arbitration. These items are going to come into play when you and the insurance company cannot agree on what should be paid on a claim. The difference between appraisal and arbitration is, with appraisal, it's property. We have to appraise the damage. Right? With arbitration, that would be for liability. So for appraisal, you have a loss. The insurance company says, we're going to pay this much. And you say, no, I think it should be this much. All right? You can request appraisal. Now, how this works is you pick an appraiser. The insurance company picks an appraiser. These two appraisers pick an umpire. The umpire listens to both sides and makes a decision, and it's final. Okay. Arbitration is the same way, but for liability. Right? The insurance company says, we're willing to pay you this. You're saying, no, this is what I want. So you pick an arbitrator. The insurance company picks an arbitrator. These two arbitrators pick a third arbitrator, which hears both sides and makes a decision. And again, just like appraisal, it's binding. That means once that decision has been handed down, you're stuck with it. You cannot appeal it to any place else. This decision is final. Your customers, or you, the insured, have to agree to appraisal arbitration, but it is a condition in the contract, right? Or they can choose not to, and they can sue. Okay. All right. Transacting insurance. There are 4 pieces of transacting insurance. Number 1, solicitation. That's advertising, marketing, trying to get the clients to meet with you. Negotiation. That means you're interacting with the client, explaining the coverages, encourage them to buy it. Execution of a contract. That means they buy the policy. They fill out the application, pay the premium, report to underwriting, they issue it, and deliver the policy. And then the last one, transaction of matters subsequent to execution of a contract and arising out of it. That means after you sold them the policy, you're now servicing the policy by adding a rider, adding an endorsement, adding a car, changing drivers, okay, or adding a child to the life policy as a rider. Right. So you're making changes to the policy that's already in effect. That's what this 4th one is. Right. You cannot do any one of those unless you have a license in your hand. If you transact without a license, it is a misdemeanor. In most states, it's a $10,000 fine, right? Just so you know, end up to 1 year in jail if it's gone for a while. Okay, so don't do any of those items unless you have a license. Okay. Now, transacting insurance deals with putting the policy on the books and keeping it there. Right. So your test questions say, which of the following is not an example of transacting insurance? And taking your wife to the Bahamas from the commissions you earned from a sale, is not transacting. That's the compensation you made from a sale. Transacting is anything to get this policy on the books and to keep it there by servicing it and making changes. Okay, so be wary of that. And it may not be Bahamas. It could be Europe or Hawaii, depending on which test question you get. But that's not part of transacting. Parts of a contract. This is another tricky area. So you're taking an insurance exam, and insurance is a contract by definition. Contracts don't have to be in writing. Insurance contracts have to be in writing. Okay? So you got to know the four parts of a contract. This is contract law. So consideration is defined as an exchange of value. Your clients provide two things of value. They're going to provide personal information about themselves, right? And they're going to pay premium. And on behalf of the company, you have to provide something of value back, right? And the insurance company provides a promise. We promise to pay should you suffer loss according to the terms of this contract. So it's the act of filling out the application, paying the premium for the promise of receiving benefits. That's what consideration is. That's what exchange of value is. Okay. The reason you buy insurance is to protect against a loss. Well, guess what? That's what legal purpose is. What's the intent? Right? The purpose is to protect against a loss. Now, to protect against a loss also means you cannot get a gain. That's how you need to understand it. Okay. So legal purpose means to protect against a loss, but another way of saying that is legal purpose means you cannot get a gain. Right. And by the way, your test goes a little crazy with the thesaurus. Instead of saying legal purpose, they might say legal objectives. It's the same thing. In a contract, we got to have agreement. That means someone makes the offer, the other party has to accept it and agree to the terms. So in insurance, as an agent, you represent an insurance company. Your job is to sell insurance to the public. You have to convince them they should buy from you. And they agree to it. So they accepted your offer that, yeah, I need insurance, right? They agree to it. They fill out the application, pay the premium. They give that back to you to give to your company. They just did a counteroffer. Here's the information you requested. Can you insure me at what you've shown in your proposal? The insurance company accepts this counteroffer and says, well, yeah, we can insure them. However, they have this situation which warrants us to charge a higher premium, whether it's a ticket for auto, a prior claim for home, maybe a health insurance claim, or maybe a medical problem for life or health, okay? So, and so they could make another counteroffer. Yes, we can insure you, but because of the situation, we're going to have to charge a higher premium. Do you still want it? And so the customer then says, okay, I need the coverage, I'll go ahead and take it. So it really doesn't matter who makes the offer. Both parties have to agree to the conditions in the contract. That's when we have acceptance. Okay? So that's the agreement, the offer and acceptance. In dealing with contracts, you have to deal with competent parties. That's people in their right mind. And your insurance companies trust you for a reason. They hired you, right? They're bringing you on board because they trust who you are and how you are when you're dealing with the public. And so if you're dealing with someone, and they don't seem like they're all there, bow out gracefully. I know as much as you're new and you want to sell and make some money, when your intuition tells you this is not good, you need to bow out. Right? And use your best judgment. I mean, they got to be mentally competent. Right? They cannot be under the influence of alcohol or drugs because they're judgment impaired. They cannot be a minor because a minor legally cannot enter into a contract anyway. Okay. And another thing is very rare, but you might see they cannot be a public enemy. A public enemy is someone armed and dangerous and wanted by the law. And you can't insure them, especially life insurance. You're selling them life insurance, the police catch up to them and shoot and kill them as they try and bring them in. And now that convicts or criminals' family member makes money from that deal, it's kind of a conflict. Okay. So that's how you want to understand that. You got to deal with competent parties, people in their right mind. Now, parts of a policy are different. So depending on the coverage, right? If it's property and casualty, it's a declaration page. If it's life and health, it's the title page or policy face. But it's kind of the same thing. It's the first page of the policy that tells you who the insurance company is, right? It tells you who is the insured. It puts the effective date and ending date of the policy, right? Tells you the type of policy actually on there also, and might give you some of the coverage amounts. Okay, so that's on the first page of the policy. It's called the deck page or the policy face. Right? Now, the insuring clause tells you the type or kind of policy you bought. A lot of times, the insuring clause is actually part of that declaration page or policy face. Right? So, the insuring clause tells you you bought a personal auto policy, and that's going to be listed on the deck sheet. Or the insuring clause told you that you bought a 20-pay whole life policy. That's on the title page. It's a paragraph at the bottom of that title page in life insurance. Okay, so for the exam, the insuring clause tells you the type or kind of policy you bought. Keep it that simple. Conditions clause. Conditions clause spells out these are the steps that you need to take to collect from this policy. So it details the conditions, the duties and responsibilities that you need to take in order to collect from the policy. Now, another way of saying that is it spells out the obligations of each party. Clients are obligated to notify the insurance company they suffered a loss. They are obligated to provide proof of loss. The insurance company is obligated to investigate, settle, and pay the claim. So it spells out the obligations of each party. And again, with the insuring clause and the conditions clause, they could go crazy with the thesaurus, and they might say insuring agreement or the conditions agreement. All right? Agreement and clause are the same things. They're interchangeable, so be wary of things like that. The fourth part of the policy is exclusions. It simply states, this is what's not covered. Right? Again, think of catastrophic losses, right? War, active war, nuclear risk, right? Earthquake, flood. For life insurance, suicide in the first 2 years, maybe aviation or military exclusions could be involved in the policy. But it just tells you what the policy will not cover. Okay. Typically with your policies, there's also a definition section. Just finding who you and you are, you and yours versus we or us. So you and yours are the insureds, right? We or us is the insurance company. So we or us are going to pay for losses that you and yours are legally responsible for. Okay. And it's defined. It defines bodily injury, defines property damage in the contract. And then you may have endorsements or riders. Again, these are the same thing. Endorsements are in the property casualty world. Additional charge for additional features and benefits, and riders are what we call them in the life and health world. Additional charge for additional features. Pay a little extra to help personalize the policy to hit specific needs. Okay, that's what that's about. So these are just some add-ons, but really the four parts are up here. And so you do want to know the difference between the four parts of a contract and the four parts of a policy. Notice that parts of a policy does include a conditions clause, but a contract, there is no conditions clause. Okay, it's kind of funny because you think, well, in order to have a contract, we got to meet conditions. Well, yeah, but it's part of the agreement. Didn't we agree to conditions? Didn't you agree to provide information and pay a premium? And didn't we agree to cover you at that price? You see, so there is no conditions element of a contract. It's only on parts of a policy. So keep them separate. Okay. Fiduciary duty. Whenever you see the word fiduciary, think of premiums held in trust. You as an agent, when you sell a policy, you collect premium. Right? Now that premium needs to go into a fiduciary account, which is typically a non-interest-bearing checking account, and then forwarded to the insurance company. You can't commingle, you cannot embezzle. Commingling is you use that client money for something and you pay the money back later. Right? That something could be for personal use, business use, what have you, and then you pay it later. Embezzling is you just flat out take that client premium money and go shopping and don't pay the money back at all. Right? If you are caught commingling or embezzling, you are found guilty of theft. Do not pick fraud. Commingling or embezzling client money is theft. The only time you want to choose fraud as the answer is if you see terminology such as, intentional, willful. Okay, you intentionally took the money. You willfully took the money and used it for something else. Unless you see those two words, it's more of a misdemeanor, innocent till proven guilty. So be wary of that. Okay. Now, when the client pays the premium and you forward it to the company, if the client chooses to cancel the policy, the company may issue a refund of the unused portion of the premium, right? Or even a flat cancellation, could be all the premium. Now, if the premium refund comes from the company, the insurance company has to refund it back to the client within 25 days. But you're the agent of record. This is your client. So if a client calls up and cancels out, the insurance company may actually give you, the agent of record, the client's premium refund. And then once you receive it, you need to return it back to that client within 15 days. Or you can talk to the client and says, hey, I know you didn't want this policy for this particular thing. I do have your premium refund. And if you like, I can actually apply it to this other policy that you have. Okay. So a premium refund can be applied to another policy for that same insured as long as the client is so informed. So that's kind of the three things about refunds. The company gives it directly to the client within 25 days. If you, the agent of record, receive it, you have to refund it to the client within 15 days. Or you, the agent, as long as you have client's permission, you can forward that premium refund and pay for another policy for that same insured. Okay. What's tricky is this last bullet. A producer may retain income commission in a trust account to advance premiums. So let's say you sell a policy to a client and you have a contract with the company where you get 50%. I'll just keep it simple, round numbers. So the client pays you, $100, right? You send 50% of it to the company, right, to pay for the policy. That other 50% sits in this fiduciary account until the end of the month when you pay your agent or yourself commission. So now, if that 50% of that premium is sitting in this non-interest bearing checking account, that's kind of a waste of money. But you cannot commingle or embezzle those funds. But what you can do is someone calls up saying, hey, I need an auto policy, but I don't get paid till Friday. Well, today is Wednesday. And so you can use this income commission in this fiduciary account and apply it towards premium for that other insured, right? Because they're going to pay you Friday to replenish that account, okay? And that's kind of what they're talking about. Now, you're really not going to do this in the real world, but in the test world, it is acceptable. A producer may retain income commission in a trust account to advance premiums, right? But be wary, every once in a while they'll throw a not, right? A producer may not retain income commission in a trust account to advance premiums, and that would be a false statement if they put that not in there, okay? And again, in the real world, you're typically not going to be doing this, right? But for the test world, it's allowable, right? Some more terms and definitions, right? Adhesion. Adhesion kind of sounds like adhesive tape, and that's how you want to understand it. We, the insurance company, print up the policies. It's in our language. So if this contract that we put together and wrote down, right, with conditions, limitations, and things like that, if it is unclear and the customer suffers a loss and we're not sure if coverage applies, the customer is going to win. Since it's a contract of adhesion, we, the insurance companies, are stuck to the language you use in the contract. So if it's unclear, the client is going to win, or the insured will win. That's a contract of adhesion. Now, knowing that, sometimes you'll see it called a take it or leave it contract. Okay, so you can take it with the insurance company's verbiage, or you can choose not to buy the policy from the insurance company if you don't like the language in that contract. All right. Aleatory or aleatoric. I'm going to give you kind of two definitions of that one. To be honest with you, insurance is an aleatoric contract because performance depends on an uncertain future event. That means in insurance, you can only insure uncertain future losses. Because if it's a certain loss, why would you insure it? If the fire is already heading to your house, the insurance company will not sell you a homeowner's policy because it's a certain loss. The fire is already on the way. okay? And so aleatory means it's got to be based on an uncertain future event. Well, this is certain, therefore we won't insure. Right? So there's one definition for aleatory. The other definition is you may get more or less than what you paid for. Right? So the insured may receive more or less, or I should say either party may receive more or less than what they paid for. And so if someone buys a brand new car, right, in order to drive the car off the lot, they got to have auto insurance. So they meet up with an agent who sells them a policy. They only pay 1 month's premium on this auto policy. When they pay the premium and provide the application filled out, the agent's going to give them a binder. A binder is an unconditional receipt for payment of the first premium. Binder in possession, they hop in their brand new car, they drive off the lot and slam into a semi-truck and total their brand new car. Now with a binder, they're covered. The insurance company has to cover the loss. So this person paid 1 month's premium, let's say $100, and they now have the insurance company paying them for the loss, which is whatever the value of the vehicle is. So the insured actually got more than what they paid for in this contract because they paid 1 month's premium and they got a payout of, in a sense, a replacement vehicle. Now that may bother you, the agent, if because your loss ratios went up, but that doesn't bother the insurance company, not like you think. Even though this person paid one premium and got a full payout of a brand new replacement car, we have thousands of policy holders that'll pay premiums the rest of their lives, and most of them will never, ever file a claim. And so those people actually receive less than what they paid for in a contract, okay? So that's kind of what aleatory means. There's an unequal distribution, but it's law of averages, all right? Some people get more, some people get less. That's how you need to understand that. As far as terminology, bilateral contracts do not have to be in writing. I mean, you're going to move this weekend and you get a couple friends that'll promise to help you move and you promise to give them pizza and beer when you're done. It's a promise for a promise. You can just do a simple handshake and you trust each other. Either one of you can back out anytime. They choose to, they back out because something else came up, or you choose to postpone moving. Okay? That's a bilateral contract. It's not necessarily in writing. Doesn't need to be, right? But it's a promise for a promise. Insurance is unilateral. It's one-sided. Life insurance especially, right? Once you buy your life insurance policy, and we, the insurance company, issue the policy, you control it by simply paying the premium. All right? So it's one-sided. Uni meaning one, lateral meaning sided. So in life insurance, after 2 years, there is really only one reason that the insurance company can cancel the policy. That's because you didn't pay the premium. Okay? So even though we, the insurance company, issue it, the insured controls it by simply paying the premium. Okay? How's that? Health insurance is also unilateral. Once we, the company, issue it, the insured controls it. But after 2 years in health insurance, there's two reasons a company can cancel you out. Number one, non-payment premium. Number two, fraud. Fraud can void the contract anytime that is deemed fraud and can be proven by the insurance company. Okay, but not in life. Suicide's a fraudulent event, but if you committed suicide 2 years after the policy's been enforced, the insurance company's obligated to pay the face amount. So you got away with fraud. Okay. All right. Personal contract is a rare question, but anytime you see personal contract, just think it's a two-party contract between the insured and the insurer. Okay. So you can't get much more personal than that. Utmost good faith. When you're sitting with a prospect, you're going to ask them questions for the application. Have you had any tickets or accidents, right? Has anyone in your immediate family ever had any major medical problems, right? And you're asking these questions, and they're going to answer you with something called a representation. To their best knowledge and belief, they're not aware of anyone in their family that had any of those medical problems. To their best knowledge and belief, they don't remember getting any tickets or accidents in the past 3 years. Okay, and you got to trust them. All right. So what they're giving you is a representation. All right. Now each party gives representations to the contract. before it goes into effect. Okay. Now, so you're asking them questions and you're trusting what they're telling you is true and correct. Likewise, you're presenting how the insurance coverage works, and they're trusting you that what you're saying is true and correct. And so you're trusting each other. That's what utmost good faith means. I trust you, you trust me. Because if we didn't trust each other, we wouldn't do business with each other. Now, I say utmost good faith means I trust you, you trust me, because that's simple. But that's way too simple for your exam. Your exam defines utmost good faith as we're going to rely on the representations of either party without any attempts to conceal or deceive. That's the exam way of saying, I trust you, you trust me. Right? And you wonder why people have a tough time on this exam, because the test goes crazy with the thesaurus and the terminology. So be wary of that. But again, through repetition, you're going to pick it up whether you want it or not. Okay. Waiver. Waiver is defined as a voluntary or intentional giving up of a known right. Okay. So let's. I'm going to go back in time during Desert Storm. Right. That was when we invaded Iraq. So during Desert Storm, the insurance companies typically had a military exclusion that if you died while engaging in military activities or in a war zone, the insurance companies would actually deny coverage during that time. During Desert Storm, the insurance company waived the exclusion, and they actually paid to those Americans that died in military action during Desert Storm. Okay? So they waived the right to deny coverage. They actually paid. Okay? That's what a waiver is. Now, once they did that, the legal doctrine of estoppel kicks in. And it says, once you give up a right, you cannot get it back. That means after Desert Storm was over, the insurance company says, okay, well, since the war is over, we're not going to pay for people in military service anymore. Okay? Because they waived the right to deny that exclusion, they had to pay. So once that goes into effect, they now have to pay because they set precedents. Okay? So waiver is the giving up of a right. It could be intentional or voluntary. Okay? And estoppel says once you give up that right, you don't get it back. So all of your policyholders, if they suffer loss because of that similar situation, the insurance companies had to pay. All right? So again, keep it simple. Waiver is giving up a right. Estoppel says once you give it up, you don't get it back. Okay? Another area where some people have trouble is domicile of an insurance company. And so where did your insurance company originate from? Now, if they originated in your state that you're working in, then they would be what's called a domestic insurer. It's an insurance company that originated or incorporated within your state to offer insurance to the public. Okay. If the insurance company originated outside of your state, but still within the confines of the U.S. territory, U.S. and U.S. territories, they would be known as a foreign insurer. Okay. Now, if your insurance company originated outside of the jurisdiction of the United States, they would be known as an alien insurer. Okay, and so domestic, foreign, alien just means where did your company or insurance company originate from? Within the state, outside of the state, or outside of the country. That's the difference. Now, it doesn't matter where they're from. Did they get approval to transact or sell in your state? See, just because a company sets up an office in your state, right, or originated in your state, doesn't mean they can just sell in your state. They have to meet with Department of Insurance guidelines and receive what is called a certificate of authority. That would mean that they are admitted or authorized to transact insurance in your state. Okay? So let's say I'm in New York, or I'm in California, right? And so let's say an insurance company originated in this state. Okay, they would be domestic, and if they got approval, they would be domestic admitted. So if the insurance company originated in New York, they would be foreign. But if they got approved to sell in California, they would be foreign and admitted to transact in our state if they got approval here. Okay, so if they were based out of Europe, okay, that would be alien to us because that company originated outside the jurisdiction of the United States. But if they're approved to sell in our state, they would be alien admitted. Right? Now, not admitted means your company did not comply with the Department of Insurance guidelines to openly sell here, or they didn't care to comply. Either they couldn't or didn't care to comply. You know, maybe it's just easier to set up a company in your state, but you sell in other states. Okay, and so that's what we call non-admitted, where they did not give a certificate of authority. It doesn't mean they're a bad company. Right? In some cases, it could be because they could not comply. But in some cases, they just don't care to. Lloyd's of London is based in London, England. They're an alien insurer, right? And they're non-admitted. They do so much business globally. Do you think they want to fill out a little application and pay some fees to get approval to sell in our state? Absolutely not. Okay. Now, they can still transact in our state, but there's only 3 ways that a non-admitted carrier can transact in a state. 2 of them are going to be specific licenses. Excess and surplus lines broker's license is one, or a special line surplus lines broker's license. These are 2 licenses that allow you to place business with non-admitted companies. Okay. The third way that a non-admitted company can do business in a state is if you call up a non-admitted company and secure coverage for your own personal property only. Okay? And so you're calling up Lloyd's of London because you want coverage on your property only. Right? Not that you're referring business to them, not that you're helping an agent in any way, shape, or form. So be wary of that. Okay? In order to deal with a non-admitted carrier, you need to have one of those surplus lines licenses, or you're calling them up to get coverage for yourself only. Okay. Now, like I got to emphasize, domestic, foreign, alien just means where did you come from? Admitted and not admitted means did you or did you not get approval to transact in this state? These 2 are not related. So your exam question may say a foreign insurer is one that originated outside of the state and must be admitted. True or false? And that would be false. Okay, foreign is correct if they're originated outside the state, but must be admitted? No, because they can be foreign, non-admitted. All right, so be wary of that. Domestic, foreign, alien just means where did they originate from, whether or not admitted to do business in your state. Okay, so keep them separate because they do kind of mix them up to try and throw you off. So be wary of that. All right. So if you haven't registered, right, I would recommend you go to lgdstudy.com, choose your course. You can purchase using the PayPal link. You don't need PayPal. You can use any credit card to get started. When you get started, follow the instructions on the email reply on how to study. I know some of you have your own way of studying and you want to test yourself, but if you notice on my site, you don't test yourself. I don't want you testing yourself. It's accelerated learning techniques. I want you to make associations. When you see this question, this is the answer you want to go for, and make that association. That's going to help you get through this test, get you through those questions. If you do have any questions, you can reach out to me. Either go to info@LGD Consulting, or even Lauren, Lauren at LGD Consulting. I don't have that up here. Okay. But yeah, if you have any questions while you're studying, any questions on whether or not or what to look for in possibly signing up with my program, do not hesitate to reach out. Okay. So at this point in time, I'm going to open up the forum. Do you have any questions? Oop. All right. Let me mute them. All right. You can either unmute and chime in, or you can go ahead and chat in any questions. Everyone's self-muted, so. Wow, quiet. Hopefully you're still awake. All right, so I did record this. I'm going to post it on YouTube. Other than that, thank you for taking time out of your evening to learn a little bit more. If you do have questions, email me, contact me, okay? Like I said, I'm going to post this on YouTube once it finishes translating over, and then I'll post it up and also on my site, okay? But good luck on your exam, everybody, and thank you again. Have a great evening.